Santelli in Chicago talking the Fed and unemployment with Peter Schiff.
Well, first of all, we'd like to welcome a pretty famous economist, author, and currently CEO of Euro-Pacific Partners, Peter Schiff. Welcome to the show, Peter.
Hey, thanks for having me on, Rick. Always a pleasure.
All right, let's start out with unemployment. Just generically, do you believe that we have a structural unemployment problem, meaning that it's stubbornly high above and beyond the labor force participation rate influences, and do you think it'll remain stubbornly high in a real way, not in a it can be lower but people aren't really getting jobs sort of way?
I think it is structural, and I think it's the government that structured it this way. The Fed with cheap money, with the government with our tax code and all the regulations, we have too many people consuming, not enough people producing. We don't have enough labor in manufacturing like we should. The government makes it too easy for people not to work by giving them viable alternatives. So we've created a situation where people aren't going to work, and we're going to continue to rely on the jobs abroad as we hemorrhage red ink, and the Fed keeps printing money to finance our trade deficits, and eventually, and I'm not talking about in the distant future, but sometime soon, this whole artificial economy is going to implode.
All right, now in that context, we can clearly see what you believe. What do you think about the Fed targeting or making a goalpost the unemployment rate?
Well, the Fed is constructing these goalposts so it never actually hits them. The Fed isn't going to tighten. I started saying this when the Fed first started talking about an exit strategy back in 2009. I started saying there was no exit strategy, that the Fed had checked into the Roach Motel of monetary policy. There is no way for the Fed to exit. All it has to do is make excuses as to why it's not. The Fed is going to keep printing money until the dollar implodes and the economy collapses. Because if they try to exit,
let me interrupt you there.
Fed can't go.
Let me interrupt you there.
Yeah.
I somewhat agree with you, but the problem is it's very hard to get a GPS on how ugly the dollar is because, of course, it only can be relatively valued against something else. And fortunate or unfortunate, the main benchmarks that most people look at are the yen and the euro. And, of course, both the countries or a group of countries on the euro or the country on the yen, they have their own issues regarding monetization, quantitative easing. So how am I supposed to look at the dollar? How's the average family going to feel this in the near term?
Yeah, I guess it'd be like a student who brings home an F saying, well, look, there's another guy that got an F minus, so I'm not doing so bad. But, the dollar is actually going down against the euro. Pull up a chart. Look at the dollar index. Look at the British pound. It's almost at a 52-week high today. I mean, we're going down against the pound. But look at the Aussie dollar. Look at the New Zealand dollar. Keeps hitting 52-week highs. These currencies, you could have bought the New Zealand dollar for half of what it is right now 5 years ago. But look at the price of gold. Look at oil prices. Look at food prices. Ben Bernanke said that he doesn't care how high oil prices go, how high food prices go. He's going to look beyond that to the valley of falling prices that reside somewhere in his fantasy land. But you're going to start to see the dollar go down against the euro.
Running out of time here. I read your last newsletter, and you seem to key on the same line I did. During the press conference, somebody brought up monetization, and Mr. Bernanke kind of seemed a little put off, saying something along the lines, I'm paraphrasing, like, I've already addressed that, we're not monetizing. First of all, Peter, define quickly what you think monetizing is, and tell me why you believe Ben Bernanke is monetizing.
Well, monetizing is when a central bank buys the bonds that the government is selling by printing money. That is exactly what Ben Bernanke is doing. The Fed is buying 90% of the bonds the government is selling. And to say that it's not monetization because at some point in the distant future he's going to sell the bonds that he's buying, sell them to who? How could it possibly be? How could you sell trillions of dollars worth of treasuries and mortgage-backed securities? Who's going to buy? At what price? If the Fed ever tried to exit, it would create a financial crisis that would make 2008 look like a Sunday school picnic. So the Fed is going to print and print and print. It's going to make up one excuse after another why it's not going to stop. And the only thing that's going to put an end to this party is a collapse of the dollar, even against currencies like the euro. And it is coming. The dollar is going to be in free fall one day. Prices are going to skyrocket for consumer goods. Ultimately, the bond bubble is going to burst. And then, reluctantly, when his back is to the wall, the Fed might finally do the right thing. But it is going to be an economic bloodbath when they do.
Well, Peter, once again, you didn't welcome the week with a lot of optimism there, but we're going to have you back and monitor the new historic movements announced in the last Fed meeting. Carl, back to you.
All right, Rick, thanks so much.